The Great Recession. The 2008 recession, also known as the global financial crisis, was a severe economic downturn that affected countries around the world. The crisis was triggered by a combination of factors, including the housing bubble, risky lending practices, and the failure of regulatory oversight. In the early 2000s, the United States experienced a housing boom, with rising home prices and a surge in demand for mortgages. Lenders responded by offering mortgages to borrowers with low credit scores and little or no down payment, often with adjustable interest rates that increased over time. Many of these loans were packaged into securities and sold to investors around the world. However, as the housing market began to cool in 2006, many borrowers were unable to keep up with their mortgage payments, leading to a wave of foreclosures. This caused the value of mortgage-backed securities to plummet, leading to large losses for banks and investors. The crisis spread to other sectors of the economy, as businesses and consumers began to cut back on spending and borrowing. The crisis was exacerbated by the failure of regulatory oversight, as financial institutions engaged in risky and sometimes fraudulent practices. For example, some banks were found to have engaged in predatory lending, while others created complex financial instruments that were difficult to value and understand. In response to the crisis, governments around the world implemented a range of measures to stabilize the financial system and stimulate economic growth. These measures included bailouts of banks and other financial institutions, fiscal stimulus programs, and efforts to reform financial regulation. The 2008 recession had far-reaching consequences, including high unemployment rates, a sharp decline in economic activity, and a loss of confidence in financial markets. The crisis also led to significant changes in the regulatory landscape, as governments sought to prevent a similar crisis from occurring in the future. The world overcame the 2008 recession through a combination of government intervention, central bank actions, and global cooperation. Government intervention. In response to the crisis, governments around the world implemented a range of measures to stabilize the financial system and stimulate economic growth. These measures included fiscal stimulus programs, such as tax cuts and infrastructure spending, as well as bailouts of banks and other financial institutions. Central bank actions. Central banks around the world also played a key role in combating the recession. They implemented monetary policies such as low interest rates and quantitative easing, which injected liquidity into the financial system and encouraged borrowing and lending. Global cooperation. The international community worked together to coordinate their efforts and prevent the crisis from spreading. For example, the Group of 20, G20, nations pledged to take coordinated action to support economic growth and stabilize financial markets. Regulatory reform. The crisis led to significant changes in the regulatory landscape, as governments sought to prevent a similar crisis from occurring in the future. New regulations were put in place to strengthen the financial system and prevent risky lending practices. Economic recovery. Over time, the global economy gradually recovered from the recession. Unemployment rates declined, and economic growth returned. While some regions and countries experienced slower recoveries than others, the global economy eventually returned to pre-crisis levels. Overall, the world overcame the 2008 recession through a combination of government intervention, central bank actions, global cooperation, and regulatory reform. While the recovery was slow and uneven, the actions taken by governments and central banks helped to prevent a much more severe and prolonged downturn. Please do support